Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Saturday, December 13th, 2025, and we're fresh off analyzing yesterday's market chatter from Friday the 12th.
That's right, Ethan. We've seen a pretty active day in the social media discussions, flagging quite a few different companies. Overall, I'd say the market sentiment is definitely a mixed bag. A lot of speculative excitement, but also some significant red flags if you really dig into the numbers.
Absolutely. Our AI sifted through a substantial amount of data, highlighting quite a few stocks generating a lot of buzz. We're looking at everything from established tech titans to some of those newer, higher growth potentials, especially in the AI space.
All right, let's jump right into our first contender, Nebius Group, or NBIS. The chatter isn't huge, with 16 recent mentions, and the user sentiment is quite limited, leaning neutral to cautiously optimistic based on a single post from someone holding it in an AI portfolio.
Well, despite the limited social data, Brooke, the news flow for NBIS is really intriguing. We're seeing headlines about huge AI demand ahead and mega AI cloud deals, even with giants like Microsoft and Meta. This really positions NBIS as a potential game changer in the AI sector, and it's been mentioned as a breakout growth stock. The community might be cautiously optimistic, but these future prospects could truly transform the company.
I hear you, Ethan, but we can't ignore the present. Nebius is frankly unprofitable. Their EPS is negative 0.19, and the operating margin is a concerning negative 0.89. They also carry a high debt-to-equity ratio of nearly 95, and their price-to-book ratio is 4.58. That valuation for a company that isn't turning a profit suggests a lot of future growth is already priced in, and it's a very risky bet right now. Given its history of being rated stay away or speculative gamble often in our past episodes, those financial headwinds are simply too strong for new money.
Fair points on the financials, Brooke. The enthusiasm is definitely for what could be.
Exactly. So for NBIS, our final verdict is stay away.
Next up, we have Tesla, TSLA. This one had the most engagement today, with 84 posts. There was a profitable options trade with a user selling puts, which indicates a short-term belief that the stock wouldn't fall drastically. Plus, we've seen significant insider buying, over 2.4 million shares by insiders in the last 6 months, a real vote of confidence. And let's not forget the long-term catalysts like Robotaxi and the new FSD model launch. That could be a massive game changer for their revenue and earnings.
Ethan, I'll grant you the buzz and the insider buying is interesting, but we absolutely have to talk about the valuation. Tesla's PE ratio is over 312, and its price to book is over 19. That's astronomical, pricing in an almost impossible amount of future growth. Their return on equity and assets are quite low for a company with such a premium. And with a beta of 1.878, this stock is incredibly volatile. Any hiccup, any delay in those future promises, and you could see a significant drop. Historically, we've classified Tesla as stay away or speculative gamble for a reason.
It certainly demands a leap of faith, that's for sure.
Indeed. For Tesla, the final verdict is stay away, and I'd add with extreme caution.
Moving on to Palantir, PLTR. We're seeing limited user sentiment here, similar to NBIS, but the company itself shows strong revenue growth at 62.8%, with healthy net profit and operating margins. They just secured a massive $448 million Navy ShipOS deal, which is a huge win for their AI-driven data solutions and points to robust future contracts. While that Navy contract is positive, Ethan, PLTR's valuation metrics are just as eye-watering as Tesla's, if not more so. We're talking a PE ratio of over 417 and a price-to-book of 66.39. That means the market is betting on an incredible amount of future success, leaving almost no room for error. Plus, their debt-to-equity ratio is 3.52, which is high. And we've seen minor net insider selling over the past 6 months. For new positions, the risk-reward simply isn't there at these levels. We've had quite a few stay-away ratings for PLTR the past too. The valuation certainly makes it a tough entry point.
Precisely. For PLTR, our verdict is stay away.
Okay, let's talk Micron Technology, MU. Now this one's exciting. The community sentiment is strongly bullish, with one user explicitly stating MUER gonna pop off new ATH for their upcoming earnings report. And talk about insider confidence. Insiders have net purchased over 639,000 shares, representing over 22% of their total holdings in the last 6 months. That's a huge bullish signal. Their revenue growth is solid, and with the earnings report coming up on December 17th, especially with all the focus on data centers and AI, this could be a big catalyst. We've rated MU as buy before, and this looks like a return to form. Ethan, I like the insider buying, and the earnings report is definitely a key event. However, MU's PE ratio is still quite high at 34.01, and their debt-to-equity ratio is exceptionally high at over 28. Yes, revenue growth is positive, but that level of debt, coupled with high volatility, a beta of 1.548, means that any disappointment in those earnings could be met with a sharp correction. You need to be aware of the leverage and the inherent risk, even with the bullish buzz. Absolutely. Caution is key, but the insider conviction is hard to ignore, especially when combined with the potential of that earnings report. It is. So for MU, with careful monitoring, our verdict is buy. Now for Amazon, AMZN. We had a couple of different posts about it today, but the first one really caught my eye. While one user classified it as a safer large cap, the numbers tell a different story. Ethan, we saw a staggering net sale of over 23 million shares by insiders in the last 6 months. That's a massive red flag. That's a significant figure, Brooke, but let's not overlook Amazon's underlying strengths. We're hearing about a data center boom and analysts like TD Cowen maintaining a bullish outlook, citing multiple growth drivers into 2026. Their revenue growth is solid at 13.4%, and EPS is strong. Even another discussion today had a user planning to buy Amazon calls, which suggests a bullish short-term sentiment. Amazon is a tech giant constantly innovating, and these growth engines could easily outweigh routine insider selling for diversification. Routine selling of 23 million shares? I think that's more than diversification, Ethan. Their PE ratio of nearly 32 and P/B of 6.54 are still high, indicating a premium valuation. While growth is there, that level of insider selling from those closest to the company, combined with ongoing market headwinds and potential regulatory scrutiny on data center energy consumption, makes me very hesitant. We've had very mixed ratings for AMZN in the past, swinging between buy and stay away. But today, the insider selling is just too stark. It definitely adds a layer of complexity to what is otherwise a very strong company. It does. For AMZN, our final verdict, despite some of the positive news, is stay away.
Finally, let's turn to Rivian, RIVN. The user sentiment from the data we processed was leaning bearish, specifically a user profiting from selling Rivian calls. However, there's been a significant surge in Rivian's stock price recently, driven by their Autonomy and AI Day announcements, including a focus on in-house AI chips. It's really turning heads as an AI stock. Plus, insiders have actually been net buyers, purchasing over 3.8 million shares. This signals a turning point for the company, and we even gave it a cautious buy just a week ago.
Ethan, while the AI narrative is compelling and the insider buying is a positive sign, we absolutely cannot ignore Rivian's current financial reality. This company is profoundly unprofitable. Its net profit margin is negative 0.61, EPS is negative 3.48, and operating margin is negative 0.63. They also carry an incredibly high debt-to-equity ratio of over 102. For a company losing that much money, a price-to-book ratio of 4.45 is highly speculative. The AI announcements are about future potential, not current financial health, and building that out will incur significant costs. Despite the recent buzz, the fundamental risks are still overwhelming. This is a downgrade from our previous cautious buy.
I suppose even the most exciting prospects need to eventually show up on the balance sheet.
Exactly. For RIVN, our verdict is stay away.
Well, that was a spirited discussion, Brooke. A lot of growth potential, but also some serious hurdles. Let's wrap up with our final list for today's deeper investigation. Investigate as buy, Micron Technology, MU. Investigate as cautious buy, none. Investigate as speculative gamble, Tesla Inc., TSLA.
And that brings us to the end of today's Daily Hunt. Before we sign off, a quick but important reminder. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
That's right. Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in.
We'll catch you next time on the Daily Hunt for Multibaggers.